Hello, everyone, and welcome to Economic Impact Edition, February 8, 2022. We're back after a couple of weeks, and as usual, I am joined by our Chief Economist, Stéfane Marion. Hello, Stéfane.
Hi, Martin.
Let's start by looking at the performance of world markets, Stéfane. A little bit of a setback, and Canada is standing out.
Yeah, Martin, after a fabulous year last year, we finished up more than 20%, and you can see it's more difficult for global equities, down 4.8% year to date. We actually corrected down 10% globally. Martin, there's fear everywhere. There's COVID fear, there's inflation fears, there's interest rate fears, there's geopolitical fears. But we've always said all along that under these circumstances, Canada can play a defensive role, and I'm happy to say that Canada's actually up year to date, not by much. But we're not down, and I'll take that anytime. And the reason why we're being so resilient has to do with what's happening on the energy front, up more than 15%. Commodities are doing well, and also banks are doing well with rising interest rates. So yes, the Canadian market, the stock market, can play a defensive role given the current geopolitical backdrop.
Stéfane, you mentioned there are many fears out there, and that's what our listeners asked us to address. So let's tackle them. First one, $90 a barrel, energy prices going through the roof. What do you think? Is that isolated?
It's more than an oil, Martin. I think it's a reflection that the global economy is still growing, and you can see that the energy sector in Canada, the energy commodities produced in Canada are at a multi-year high, highest since 2014. You can see that metals at an all-time high, agricultural products at an all-time high, forestry products, after dropping significantly at the end of last year, are now up significantly to start the year. So all in all, Martin, you put them all together, and the overall index for all commodities produced in Canada is new all-time high, so that's quite supportive of profitability for Canadian corporations.
So key question, is that temporary? And in order to answer that, as usual, we did that in the past, we need to look at inventories.
Yeah, and where we are in the cycle, Martin, and the reality is even though we had a gangbuster year last year with consumption being very strong, we're starting the year with very depressed levels of inventories. And yes, there was a big inventory rebuilt in the last quarter of last year in the U.S., but it barely shows on this chart. If you look at the ratio of inventory to sales, we're still significantly depressed. And just to get back to pre-COVID levels will take many quarters, perhaps more than a year, Martin. So yeah, that means that global industrial output, industrial production, manufacturing output will reach a new all-time high in 2022.
Let's talk about another fear, Stéfane, which is tightening monetary condition. What's your take on this one?
Well, historically, once you get a tightening cycle in the U.S., it makes things more difficult for equity markets. I say, well, let's be careful, Martin. The early stage, not necessarily, because monetary policy is not restrictive. But the other thing I want to point out is that, it's not the same everywhere. And in the U.S., there's expectations of tightening, but in China, there's actually been an easing in monetary policy. So you put this together and you say that overall, global financial conditions are not likely to tighten significantly if one country is going one way and the other country is going the other way. So I think that it's still a pro-growth environment in the current context.
And why do we see this disparity?
Well, it's not that China's reckless, Martin, because people say there's inflation everywhere. There might be inflation everywhere in OECD economies, but in China, as you can see on the slide, inflation is running at 1.4% versus 7% in the U.S. So China has some leeway to ease monetary policy, and that's what I find encouraging. They had a strong currency, which now enables them to ease monetary policy, which I think is supportive for emerging markets, generally speaking, and for global growth.
We also have geopolitical fears, and Stéfane, I think you could fool many of us with a quiz.
Yeah, the quiz would be who's the best performing currency versus the US dollar year to date, and everybody's fearing an imminent invasion of Ukraine, but the best performing currency versus US dollars so far in February is actually the Russian ruble, followed by the Polish zloty, and Russia is supposed to be the instigator of Ukraine invasion, and Poland is where the Americans have sent many soldiers. So the fact that the markets is pushing up these two currencies suggests that despite what you see in headlines across many medias, the market is saying, well, you know what? We don't think this is going to happen at this point in time. So this would be a fantastic outcome if it doesn't happen, Martin, because it would probably depress oil prices by $10 or so, limit the pressure on inflation, and make everybody happy. So hopefully the market is right, and we don't see a Ukraine invasion anytime soon.
Let's zoom in and come back to Canada. Fears of inflation. What do you have to say there?
Rate hikes.
How many?
5. 4.7%, Martin. Core inflation above 2%. The Bank of Canada can no longer delay interest rate increases. So, yes, we're looking for 5 hikes starting in March, but fear not, Martin, we're not going to be restrictive with interest rates barely above 1% at the end of the year. So I think we can absorb that at this point in time.
So 5 rate hikes despite a pretty ugly employment report.
Yeah, but Martin, you have to put this January lackluster jobs report, you have to blame it on governments because they actually tighten sanitary conditions in Canada. And if you look at the stringency index, Canada versus the U.S., Canada is much, much tighter than the U.S. at this point in time. Martin, this is hardly justifiable going forward, given the fact that we now have 85% of our population vaccinated in this country. That compares to 75% in the U.S. So clearly, Canadians have done a fantastic job in getting vaccinated, so I would hope that there's room for these sanitary measures to be eased in the coming weeks, particularly given the fact that, hospitalizations and intensive cares is actually coming down. So I won't be too distressed about the January jobs report, Martin. I think when you look at this with an easing now of sanitary conditions, growth should be stronger, and that can just still justify Bank of Canada rate hikes starting in March.
So maybe, Stéfane, in conclusion, we had talked about 2022 being a little difficult at the beginning, but our companies are doing well, and we still think that this should be reflected in the stock market, right?
Yeah, we're transitioning, Martin, right? We'll know how we live with COVID in an endemic fashion instead of pandemic. Then monetary policy has to normalize. We'll learn to live with all this. It will be volatile, don't get me wrong. But the reality is we're still very far from restrictive monetary policy, so we still think that there's room for the global economy to do relatively well in the coming months. Yes, February, March, a little bit more difficult, but I think after the Olympics, after China starts reopening its economy post-Olympic, we'll see profitability doing better, and maybe with the appeasement on the geopolitical front, we'll have a decent year. So not promising returns like we saw last year, Martin, but I think...
that's fine.
I won't do that, but I think there's still scope to be optimistic for the first half of the year.
Excellent. Thank you very much, Stéfane. Thanks for listening to us. We will be back again next month. Take care.